But trading should be the rational process we've just discussed, and if you start getting swayed by emotional decisions, you will increase your risk and you're probably going to fail. Knowing your risk level is a major thing in relation to trading in general and trading plans specifically. How much cash are you willing to risk on a single trade? And again, each of you will be different. Some of you will have a 2% risk, some of you may have a 10% risk, and that risk may vary between the asset classes you're trading. It needs to be determined and written down as part of your trading plan. There is no point in having a trading plan that states that you risk 5% and your emotion kicks in and you decide that you're going to change it now because you're right and the market's wrong, and therefore you drop 8-10% just simply because you've let your emotions come into play. Trading is going to be risky, and when the market moves against you, you need to know how much cash is on one particular trade. The amount of risk you're willing to take will vary depending on who you are, what you're doing, and on various other factors, including your appetite for the risk, the amount of money you've got invested in your account as risk capital, and the particular trade you're looking at, whether it be equities, futures, or some other asset class, currencies, gold and silver. Those risk levels will differ with each individual asset class and possibly trade that you're actually taking. If we use an example of currency, whereby you're, well, in this case the US, you're willing to risk 2% of your cash balance in your account, which you would have at Get and be on your platform, and you've got 10,000. That could be Aussie, Euro, pounds, or US is in this case. Therefore, the total risk you're willing to put on a single trade is 10,000 by 2%. Okay, so you would put your stop loss in your on your trade as an exit strategy at that 2% level. Okay, you then need to work out, or you may wish to work out, how much you're going to risk on a single day, whether it's the total 2% of that capital on a single day. It may be that you're willing to risk 5% on a single day because you're a day trader, or even more on a single day because you're a longer term trader. So if your risk per day is only $200, then one position could take you out. Does that mean you square up your other positions? Does that mean that you maybe lighten some of your other positions? All these things need to be considered in your trading plan. So you're not only looking at a single trade, you're also looking at a day and possibly a week and possibly a month, so that you can monitor and assess how you're going in your trading. You need to have goals predetermined before you even start trading, we believe. Some of you are going to have short-term goals, and that may be because you're trading currencies or futures on a much short-term basis. Some of you who are doing self-managed superannuation funds and are looking at equity markets or trading CFDs will have longer-term goals. These again need to be determined. You should set these out on your trading plan. They need to, however, be realistic. So don't set goals, either short or long-term, that are totally unrealistic and unachievable. You need to be able to achieve some of these goals, at least, on a regular basis. Your short-term goals will relate to, let's say, daily profit targets. What am I looking to achieve today? If I take a position when the market closes tonight, or when I revalue my books or want to have a look at it again, what is my profit target, for example? Your longer term goals will, what would I like to make over the week, the month, or what are my annual profit targets? And these should all be predetermined. You should have a target in mind that you look to achieve as part of your objectives. You also need to do homework. Everyone should be looking at doing something with some sort of research, whether it's something like this, which is a little bit of education, whether it's more specific in relation to a particular thing that you're looking to trade. What's happened in the markets overnight? Markets are very, very correlated at the moment due to what's happening economically around the globe. So you need to know possibly what's happened to BHP in New York overnight before you place a position at 10 past 10 on the next morning. Rio's the same, and other offshore stocks. What's happened to a currency overnight? What data has come out overnight, and how is that going to affect the market when it opens, for example, and what's coming out today? These will differ depending on what you're trading. For those of you that are only trading Australian equities or Australian CFDs or futures on the ASX 200, for example, you may only wish to know what's coming out today. However, what's happened in the US, whether it's be a farm payroll or one of the other inflation indicators, will affect how our market operates first thing in the morning, and will continue to affect it during the day. It will continue to be affected if there's a press meeting or a politician with some sort of influence is speaking at the press club in Canberra over a lunch or something like that. Typical things that will affect markets and affect your position. So you need to, what do I do? Do I take a position today because we've got unemployment figures